It is that time of the month, OPEX week, with trillions of dollars of options expiring, and we all should be worried. Not just about OPEX, but about inflation. We have inflation data coming out tomorrow. And if inflation misses, things could get ugly as a potential government shutdown hangs in the balance. So today we're going to talk about the key drivers of the market this week. There are some great charts and there are some very worrisome charts. So join us today as we bring the stats and discuss the week and the day ahead. Hello, ladies and gentlemen. Welcome to the daily recap show where we talk about stocks and the financial markets. If you like this video, please subscribe, hit the notification bell. Let's get into it. Truthfully, it was a very average day today. The market opened up lower. We saw selling in technology, comm services, financials, but we did see a bit of green action in defensives, healthcare, and energy. And we showed you guys this chart yesterday. On Monday, we saw an average annualized return of 72.7% for 2023 in the S&P 500. And while that was true for the Dow and the Russell, the S&P 500 made a slight loss, just under 0.1%. But we've seen a major sentiment shift in the market over the last couple of weeks. But that being said, we are still seeing people buy puts. And when we see levels elevated, and when we've seen the put call ratio to levels elevated this high, like we did in 2020 and we did in January 2023, we tend to see a melt up in the indices right here. Until we do see this level get back down lower, it's probably going to be very supportive for equities. However, this is in the S&P 500. We've seen a ton of call volume in the IWM. Huge amounts of call interest coming in. And I think people are looking at the IWM as being extremely cheap. And I believe it's trading at a PE of about 12, the Russell 2000. And you have to look at that historically and say the IWM, the Russell 2000 is the cheapest it's ever been. And while I do think small caps are attractive, it is max pain this week. So where will we see the IWM finish this week? Now, max pain is around 175 for the Russell 2000, but we could see huge amounts of put and call interest right on the 175 strike and also on the 170 strike. So I don't think the market is going to move much between these two areas right here for the Russell 2000. There's also huge amounts of calls on the 180 strike. But for the SPY itself, max pain is 430, currently about here, 440. There is about a 2% downside to the 430 level. Max pain theory suggests that price will hover to the max pain level because that's where the most amount of contracts will expire worthless. However, if max pain theory is anything to go by, there's going to be a lot of volatility this week. Moving on, we had earnings, and there wasn't much to go on with earnings this week. But the market has met its expectations that as of today, Q3 2023, we have seen a 4.1% increase year over year for the quarter in earnings. And we are expecting a 3.2% in Q4, Q1 24, 6.7%, and then a double-digit growth of 10.5% in 2024. These earnings do look rosy. This is FactSet data right here. Carson Research is expecting a 12-month forward return of $241 in earnings per share. So as it stands right now, it looks like the S&P 500 earnings growth is on track. I mean, we are hitting the Q3 earnings. Who's to say we won't hit Q4, Q1, and Q2? But where does that leave us with valuation? And the S&P 500 forward 12-month PE hit 17 just 2 weeks ago, and now we're at the 18 level. Still, I think historically cheap, below the forward 5-year average, although the rate environment was different over the last 5 years. But everything in this market is dependent on treasuries. We saw treasuries spike up on the Moody's news and then fall intraday. They didn't really move much. They were sort of flat even. I think the market is sort of waiting the bond auctions later this week as well as the inflation data. Let's actually talk about treasuries as a whole, specifically long duration treasuries. And let's talk about, are they a buy right now? So we do know that the TLT, the 20-year bond, has seen, peak to trough losses of about 54%. And in the last 5 years, close to 23% from here to here. And this is on the back of 3-year losses. Now, in the history of the US, we've never seen treasuries drop for 3 years straight. This is going back to 1787. We could see -7% so far in 2023, -47% in 2022, and -4% in 2021. As interest rates increase, bond prices decrease, and we saw the federal fund rate go from 0.25% to 4.1% in just under 18 months. very, very crazy. And when you have interest rates go from pretty much 0 all the way to 4.1, that's a very, very big increase. And that's why bond prices have absolutely tumbled in the last 3 years. What about other bond bear markets? Generally speaking, once the trough has been found in treasuries, we generally can expect a 1-year recovery anywhere from 6% all the way up to 32% return. Let's overlay the market trough from October 19th. Assuming that the peak was this and the trough was this date, a peak to trough market performance of negative 51.32%. Look at this compared to all of this. What will the returns be? Could this be the trough? We don't know. But here are the consensus opinions. Goldman Sachs believe that treasuries have peaked and that monetary policy and fiscal policy will ease in 2024. They also believe that investments in rates, credit, and equities will outperform cash, and an emphasis on duration. So long story short, 10-year to 30-year treasury is what they believe will outperform in 2024 over cash. But this is the opinion of a bank. Let's have a look at the stats now. One very, very key indicator of rate cuts incoming is an inverted yield curve. Currently, our yield curve is inverted. And when we've seen similar instances in the past of an inverted yield curve, it's normally followed by a recession. These gray lines are recessions. And once a recession has come, we've seen a decrease in rates, a decrease in the Fed fund rate. Always when the yield curve has been inverted, we've seen a decrease in the Fed fund rates and subsequent interest rate. But the Fed fund futures is also pricing in rate cuts in May 2024, June 2024, and it's pricing in about 4 rate cuts through to 2024, very close to the 4% mark. Let's play devil's advocate, because looking at all of this, you could say, wow, treasuries are a buy, but what's the economy looking like? There's various other points of data that we do need to look at. This is total construction spending in the United States. And based on this, from January 2023 all the way to where we are right now, construction spend has doubled. And this is mostly on the back of government spending. This is one of the reasons why debt issue is so big, because the government is spending heaps and heaps of money to avoid a recession. It's why we got a 4.9% GDP print just a couple of weeks ago. Adding on to this, we do know that the labor market is actually quite strong. Job openings remain high in virtually every industry and layoffs remain low. So we have two conflicting points of data based on how you want to look at it. You could say that because rates are expected to fall next year, that could be very positive for bonds. But also we have a very strong economy if you look at the stats objectively like this. And that's where the answer to are treasuries a buy right now can be very, very hard. And while I don't have an exact answer for you guys right now, I will keep digging into this trade and come up with my own opinion whether long duration treasuries are a buy right now, or if you should still keep your money in the shorter end in money market accounts. But let's move on to seasonality. I saw this headline right here, and the House GOP hopes to pass a funding package to avoid the shutdown. But it doesn't really matter. This chart is really blurry, but you see that stocks tend to ignore government shutdowns. In pretty much every government shutdown we've ever had, during the shutdown, the stock market has returned 0.3%, or the S&P 500, and it was higher about half of the time. But that being said, 12 months after the government shutdown, the S&P 500 is normally higher by 12%, almost 90% of the time. So government shutdown is nothing to worry about, guys, and hopefully they do pass this funding package to avoid the shutdown. I have some more seasonal stats here for you. November 15th to December 31st. So as of November 12th, the S&P 500 is up 15% in 2023. Over the last 22 years, when it rose 5% or more by November the 15th, the rest of the year was positive. 27 times positive, 3 losses. And we can see that the average change was 3.49% in just 6 weeks. And 1% moves or greater happened 22 out of 22. So this is the chart we've been following all month. We just had the 13th day. We said that this week was going to be a very choppy week with OPEX that could lead us to probably moving a little bit lower towards the end of the week, and it seems we are on track to do that. However, we are already positioned long, and let's have a look at the charts. So the SPY put up a green candle. That's because it actually opened below the high of Friday. If we zoom in just a little bit, we opened right here. Bears took us lower, but then we did finish the day higher, and we actually did move above the high intraday, but bears brought us back to equilibrium. One thing that did change from Friday is that we flipped back to positive gamma. Once we hit this 4400 4500 strike intraday on the SPX with a positive gamma condition. We saw dealers buying into this, and it actually supported the move all the way up to about here, this next high volume node strike, this next high gamma strike, which is about the 4423 level, which is where bears came in. Dealers bought here, dealers sold here. This tends to happen in positive gamma. Dealers are sellers of strength, buyers of weakness. Now there's a huge gamma strike. There's a huge gamma strike here at 4450 and not much resistance up until 4500 if we do get above this level. So bears really do want to push above the 4450 level. And what we're looking for in CPI are these stats right here. We're looking at core CPI of 0.3%. Anything lower and it's going to be very positive for the market. Core CPI is the major driver of price action tomorrow and for this week, as well as OPEX. And then we do have PPI and retail sales on Wednesday, and then jobless claims on Thursday. But thank you so much for watching, guys. If you like this video, please subscribe, leave me a like, hit the notification bell, and leave a comment. You know I love you guys.